Hello. Uh, Welcome to another week of the weekly briefer. Last week I had to take a week off because I had school, uh, midterms, and so forth. But yes, again, this is Cadis Brooks. I'm doing the weekly briefers to inform viewers about investment strategy, market strategy, foreign policy, and those things related, and most importantly, get across my particular market strategy for self promotion for a future investment firm that I'm interested in creating. Today's list, again, of things to talk about is quite short, but I like to keep things short so that things don't get too bogged down in lengthy discussions that would be best off for study rather than just for basic presentation and talking points. So, we're going to talk about oil. We're going to talk about how I sold Suncor at a very profitable rate, about 30%. We're also going to discuss on a former point about buying businesses. There's a very interesting book that I've been reading. I'd like to share that information so that people will have strategic and legal advice from professionals when it comes to buying businesses. We're going to talk about the Evergrande Crisis coming out of China. Very important. China's going through an economic fallout right now. Major recession is coming. Very important to keep your eyes on, especially for global markets. We're going to talk a little bit more about investing strategy with regard to growth stocks and also underlooked stocks and how to avoid popular stocks that produce a kind of risk because once they're in popularity, the next day they're not. You could lose a big portion of your wealth just based on the speculation of popularity. And then we're going to talk about the major fundamentals of price to earnings ratios and how stocks can be predicted quite well with that price to earnings ratio. And then we're going to get into a little bit of foreign policy with regard to the United States and China and how they're repairing some of their international relations, trade relations, and how that might impact the stock markets. And then we're going to get down to the reality of things of how they're actually competitors in the economic world and how that is going to be a long-term tension that we're going to have to live with and factor into our stock market strategy. And then we're going to get a little bit more into China's particular weaknesses in the real estate market and how massive that real estate correction is going to be. So first off, I did sell my Suncor shares. I know that in previous videos I have promoted Suncor as a very good pick. I still think Suncor is actually a good stock market investment. It's one of those things where I particularly like to sell before things start to get worse. I like to sell during the golden times, and even if I miss out on a little bit of gains in the future, I know that I've still sold at a prime time and I booked the profits and I haven't dealt with one of those things where the stock is up and down and you spend a lot of time researching and investing, and then 1 second it's popular, next second it's not. It's an important contrarian move to actually sell when things are quite popular in that range, and to buy when things are unpopular. So I did make the sale, but I still think, looking at it fundamentally, that Suncor is a very valuable business, very good fundamentals. It's going to be very valuable for the near future. What you have to remember is that oil is cyclical. It's one of those natural resource assets that when you buy, especially in the stocks, you have to keep up to date. Rather in the shorter term, which is unfortunate, but you have to keep up to date with the news and the developments and understand that prices are going to be high and low, especially with OPEC and the competing Canadian and US producers of oil. And so when you see prices go quite high in oil, You can expect them to come down eventually. We've already seen the oil price go down a little bit. I still think the oil price is going to be quite good, in a very good range for businesses producing oil and selling oil to make a lot of money. So that's good for investors in oil. I do think eventually it will cycle down again based on competition and oversupply, and it's losing ground in popularity. I think that with regard to Suncor in particular, it had already shown its income statement for the latest quarter, which was really good. It profited substantially from that. I saw those profits. I was looking into the U.S. and how Biden and some of the major investment banks in the U.S. were saying something about demand destruction, in the sense of if the prices are too high for oil, that will hamper the demand recovery from COVID, and it will be detrimental to the U.S. economy. So we've seen Joe Biden go out of his way to potentially tap reserves for oil and try and get more product to the market to lower the price. I particularly didn't like dealing with that every day. As a cyclical investor into oil, I had to pay a lot of attention to the oil news. I was up, every day on a regular basis, analyzing the markets, and I noticed that there was a very strong trend coming out of the U.S. to ramp up production, to somehow get more product to the market to lower the price. With so much control in the markets, with Joe Biden's authority and these major producers in the U.S., I decided to book my profits early. I could still imagine that these major oil stocks are going to do very well until the end of the winter at least. So if people are still interested in holding those oil stocks until then, that it will probably be a very good move. But I decided to reinvest my money into more financial assets, like the banks. I'm thinking about potentially Visa, though I'm not exactly sure right now. I reinvested into TD Bank, Toronto Dominion, just based on a very safe analysis of how interest rates are going up and how banks, especially big banks and ones that are growing like TD, how they are set to benefit from that, while the rest of the market seems quite a bit riskier because with the rise of interest rates, we could see there being, and inflation too, there being a kind of disruption in the supply chain and prices going up for production and money getting more expensive to borrow, because of course these companies tend to have about 20%, 30% in debt. The price goes up. To have that debt, that's going to change the fundamentals. But then, of course, to take out more debts for more growth, that's going to cost more as well. So I made my decision based on that. Now, changing the topic here, we've talked about how buying a business or starting a business can be quite profitable, and that it's very good to diversify your income with more businesses, like the Warren Buffett model. There is a particular book that I'm reading. I scoured through quite a few different books to reach this one, so I thought it was of particular interest to share it. It is called The Complete Guide to Buying a Business, and it's written by a lawyer. One second, I'll get the author's name. It is written by an attorney named Fred Steengold, and I have been impressed by it. It's important to read a book like this because it will help you navigate through the technical legal aspects as opposed to the pure strategic aspects, as in finding something that is profitable, that is set to grow, as opposed to that more strategic side of things. This here is going to be a perfect hand guide to get you through the promissory notes, the the agreements that you make with the seller, the potential financing that's quite common in buying a business, and how you can get the seller to help finance for a longer period of repayments, for checking anything to do with legal liens, financial liens on the business that you're buying, anything to do with the law of buying a business. This here is going to help you. It will also save you quite a bit of money when you go to see a lawyer or an accountant or such wise, and you will be able to ask specific questions, take care of some of the important work yourself, and be able to better analyze and review the work that these lawyers and accountants are going to do for you, and be able to guide them strategically through the legal aspects. And it's important to know that when you're making such a big business decision as buying a business. This one here is geared specifically towards buying small and medium-sized businesses, which can be quite profitable, but again, at the same time, you need to go through the finances and whatnot and make sure you're not going to get ripped off in the market of buying and selling businesses, because there could be quite a bit of money put on goodwill or something like that that isn't worth it. But at other times, buying a brand that's already established with a strong customer basis is the best way to go about investing and entrepreneurship. Next, we're going to talk about the Evergrande Crisis and China's fallout economically. This is very important. I'm thinking about doing a case study specifically into China. It's very timely because China, which has 30% of its economy based on real estate and real estate development, is right now going through a major real estate crisis. Evergrande, which was the biggest real estate company in China, lots and lots of debts put into building houses and other sorts of properties. They were employing so many people invested their money into this company, and now when they thought they were going to have a property built for them, they are actually going to lose out on their entire investments because Evergrande can't pay its debts and it's going to go into default. At least that's what the prediction says. Right now they're struggling and scrambling to pay off debts. Actually, Evergrande has been delisted from the US stock exchanges. And so, like I said, it's not Evergrande specifically is 30%, but 30% of all the real estate companies, the real estate companies of China make up 30% of the economy of China, and the real estate sector is going through a major crisis because of oversupply, which is something you don't hear as much when you're coming from the US or Canada. Usually it's a major problem with way too much demand, making prices surge, especially in Canada, and we have yet to see a significant correction with a lot more supply to do such a thing. But in China, it's the reverse. They've got way too much supply, and so you're going to see a prolonged economic crisis due to the real estate sector in China, and it's going to be slow and painful because slowly by slowly, real estate companies are going to go out of business in China. Not all of them. Most real estate companies are going to do worse, but what's going to happen is that they're not going to be able to develop more real estate, and they're going to have to sell off properties. Lots of their properties won't sell at a good price, or they won't rent because there's too much supply. So that's 30%, roughly speaking, when you're talking about the macroeconomics of China, very significant. And so this has had very broad scale effects on the Chinese market. So you can see this, especially when you're looking into ETFs, which are kind of like indexes. They're general accumulation of major stocks. And then you can see how these major indexes or ETFs have crashed 30% or something very significant around that range. So China is going to be something to follow. Whether or not this is going to have a global economic impact and cause a global fallout in financial markets, we have yet to see. Although I do see that as unlikely, and I think that the impact would have to do with how related these debts are with the broader markets of Europe and the US, North America, and other big economies. But definitely in China and whoever's quite related to that, whoever's quite invested in that real estate market, there had been a lot of folly in investing. People had thought that China was just going to continue to grow and grow and grow at rates so fast, never seen before, or just so fast that you had to get on board. And now you're starting to see that those predictions were fallacious. They were wrong. People overlooked 30%, considering the real estate market of the macroeconomics of China, which is very big. So there probably was a lot of investors in China, and so we're going to see the consequences of the losses that these investors are going to take due to this real estate crash. So that is going to be interesting. Once again, there is talk about China and whether or not the worst has yet to come. I don't think the worst has yet to come, and I don't think it's going to be a sharp rebound. Real estate is one of those sectors that is the growth is long term for it. The investments are long term, and it will take a long time for the real estate markets to correct and potentially rebound. I know that there are a lot of promoters of China that think that they can promote news about economic developments or wavering in the Chinese economy in the sense that it's about to rebound. That's a lot of wishful thinking, and they're doing self-promotion. If you look at the fundamentals, you will see many businesses taking losses or downgrading their predictions and profits. You're seeing that the China crackdown on the tech sector and monopolies, some of the major drivers of growth in that country. You're also seeing a major oil crisis throughout the fall in China, which is continuing on into the winter. And then you're also seeing a slowed COVID recovery, potential relapses in the COVID sector. I would say that China is a risky investment right now. I know that investors like Charlie Munger see there is potential growth, but what I would tell you is that what he's doing is he's buying through the perfect storm. He is buying at a time when crisis is high because he thinks that that is the best prediction to get a good deal from a crisis, is to buy when there's the most uncertainty. And I don't think that the worst has yet to come. As I said, those fundamentals are still playing out, and you will see further declines in the Chinese markets, broadly speaking. Of course, those are my predictions, not necessarily going to happen, but I think that's much safer than thinking that things have all of a sudden come to their worst and now we're going to rebound when there's still major developments to happen in this economic fallout. Next, we're going to get into some growth strategy. That's a topic that I've been covering. So, to be a contrarian investor, which is quite wise, is one of my particular strategies. You want to avoid stocks when they're most popular and to get into them when they're unpopular. Now I'm talking about actually getting away from the fundamentals for a second. You always want to invest into companies that have really strong fundamentals, and that doesn't include the popularity. The popularity side of things is a little bit more speculative, but the fundamentals are not speculative. That's long-term investing. That's investing into companies that have really strong portfolios, really strong balance sheets, income statements, and they're going to continue to grow their income and their profits for the future. But now, at the same time, you can look at many businesses and they have really good income statements, really good balance sheets, and they're popular because of that. But the popularity with the fundamentals drives the price for these stocks too high. And if you get into these stocks when they're too high, they can often come out of popularity and then start to decrease substantially. It's actually very risky. The major investors, Peter Lynch, Warren Buffett, they have said that some of the riskiest investment is actually going into a very popular stock with great fundamentals, but at too high of a price, it corrects, you lose 30% of your investments. These are things you want to avoid. So you have to have some sort of skill in being able to understand when a stock is popular or unpopular for the wrong reasons. And what that means is that you can look for times when stocks are unpopular, but they have a great financial record, they have great growth prospects, all these major bonuses on the fundamental side, and then you say, well, this stock here is underpriced because it is unpopular. And then you can make your investment decision, and we hope that eventually the Wall Street and the other major investors, the different firms that invest, the banks and so forth, they take a look and they say, you know what, the fundamentals are really good on this business. Let's start investing. Let's upgrade its rating. And then all of a sudden you see it come into popularity and you can make a lot of money like that. So that's one aspect. And then you can add even further growth prospects. So you can take a look at a smaller company. It's got really good fundamentals. But then you say, hey, this one's growing. It's been growing its profits reasonably well, 20%, 30%, very good. It's been doing this for the last couple of years. Or you see some major development in its income statements. The most recent one, you say, oh wow, it's just became profitable with its new power plant or something like that. Some new big investment that the company made is paying off. And so you see this this growth element, and you say, hey, you know what, this is still unpopular. Wall Street hasn't gotten to it yet. The investment banks have overlooked it. And so you say, okay, let's get into this, and then you can see it grow. Plus you can see it gain popularity. Plus you can see the strong fundamentals behind it. And so that is an interesting strategy. Sometimes with the smaller growth stocks, you're not going to be able to invest as much money as you'd like because the volume isn't high enough yet. But if you're in it for the long game, you can wait for the volume to grow. But then you can also just invest at a safe rate compared to the volume, in the sense that you don't buy way more shares than the volume of daily sales for that share can produce. So that's an interesting point, one that Peter Lynch is particularly supportive of, and he has a very strong proven track record, one of the best of all time, with regard to that kind of growth strategy. The next point is how stocks often follow their price to earnings ratio. And this is one of the most predictable ways to manage stock research, is to take a look and see if the stock has been responding rationally to the market, in the sense that there isn't some sort of weird one-off where the earnings are surging but the stock is falling in price. If it is following the market rationally, it will tend to have a price to earnings ratio that increases while the stock price increases and declines when it declines. So you can say, for instance, if the price to earnings ratio gets better in the sense that the earnings increase, the price goes down. You can say, hey, the the stock is about to correct. Let's invest. You can say, you know what, this, let's say it hasn't had some sort of irrational pattern, and it's actually going at the same pace that the earnings are going at. You might say, you know what, this here is fairly priced. Let's not invest because it's not a good enough deal. And that's a particularly smart strategy. It's not enough for us to say, hey, sometimes the market's irrational, sometimes they're not. Let's understand what we mean. Why do you say that it's rational or irrational? Because if it's following its price to earnings ratio, in the sense of how the price to earnings ratio is graphed, and you can see the chart of it going up or down, and then you see the price of the stock going up or down. So if you see that it's completely following its earnings basis, then you can probably say that the stock is fairly priced. There's other reasons, and we can get into that more, but this is one of the most fundamental. I'm always going to bring my viewers back to the fundamentals of earnings, the power of that income statement, that balance sheets, low debt, all these major factors, because stock market investing can be much easier than people make it seem, just by following those basic fundamentals, as Benjamin Graham had proposed many years ago, and is still fundamental to people like Warren Buffett and other major investors. So let's keep it simple and get those points right, and understand what we mean by rational and irrational markets, right? Because we want to pounce on opportunities where the market is irrational, but it's actually favorable for investors to jump in, invest lots of money in an undervalued stock, and watch it go up, right? And so it doesn't matter if it's an economic crisis, if there's COVID or the 2008 financial crisis. It doesn't really matter about all those points as much as it matters to get out week by week, month by month, do your stock market research and find good deals, right? It's the same thing as going out to the store and bargain hunting, and that isn't too difficult, so let's keep this as simple as we can. On the last point, basic points, I'm trying to keep this short here. For foreign policy, let's talk about the US and China. Ever since Joe Biden has gotten into power, there's been an expectation that the relations are going to improve. We haven't seen too much in that development, but they recently had a meeting, and that went well. So the developments in their relations, especially with regard to trade, have been improving. That's very important. But I still think that when it comes to how the markets are reacting or how investors are reacting, we've got to understand that it's going to be long-term competition in commerce and economy. If you see anything to do with international security and how there's competition as world powers in that regard, we're going to treat it mostly as economic, or at least economically related. And so expect there to be long-term competition. Hopefully it doesn't lead to trade wars as we saw before, but don't be surprised to see very sober, rational economic calculations between the two countries, especially in a competitive sense. And don't be worried too much when you see those kinds of developments in the news. That's very much predicted in foreign policy classes or politics classes. We would expect there to be quite a bit of competition between two world powers at that rate. One more time, I want to emphasize China's weaknesses in the real estate market. Again, if you're coming from Canada or the US or Europe, you're always thinking that the real estate market is never going to correct. The prices are always going to get higher. There'll never be enough supply, but it's not the case in China. Prices are tumbling. These companies are tumbling. What you would see as some of the most stable real estate companies in Canada, you could say, hey, they're great investments. Your money can't be safer than in these real estate stocks. It's not the case for China. There's too much supply. And as I said, it's not a very liquid market. It's not a very liquid market. or sector, it is difficult to move houses, selling them, buying them. There's lots of money. It's difficult to make houses. The land that's been used for these places, if the rent isn't there, it's major losses. Not to mention, it was quite a bit of slow growth for these major real estate companies to get to the profitability that they had supposedly gotten to. The real estate sector, as you can imagine, any kind of real estate development and construction and whatnot, it takes a very long time. It's very capital intensive, usually involves a lot of debt, and so don't expect there to be quick changes in the real estate sector there, and don't expect speculation to matter as much. It's not one of those things where because they're unpopular, the real estate sector isn't doing as well. That's not the case. It's actually based on hard microeconomic factors of supply and demand. There are far too many places for people to purchase or live, and they're not able to sell them at good prices. They're not able to rent them. They were so capital intensive to get into in the first place, and these companies have major debts, and so it's not going to be a happy scene for a long time to come. Thank you very much. This is Cadis Brooks in the weekly briefers, where I'm getting to you hard facts, economic strategy, market strategy, foreign policy. I have a master's degree. I put my life into this research and into politics and political economy and into finance. I have accounting, some accounting classes from school, high-level mathematics as well. And so if you're interested in more videos, please subscribe and click the like button. And I look forward to future promotion about an investment firm. And thank you all for watching.